We're jumping straight into Reddit today. Everyone is watching the price action, but the real story is the massive 70% revenue surge and the billion-dollar buyback.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And if you want to keep getting these market simplified breakdowns delivered straight to you, make sure to subscribe and hit the like button. It really helps us get this info out there.
So let's strip away the Wall Street noise for a second. I mean, we see the stock chart, we see the headlines, but why does this specific quarter change everything for Reddit?
It's what I've been calling the early meta parallel. I think is the key theme we need to unpack. For a long time, the question was, can Reddit actually monetize its massive user base effectively?
Right. That was always the knock on it.
And the numbers from Q4 2025 just gave us a pretty resounding answer.
Okay, I want to push on that comparison, though, because early meta is a massive claim. When we talk about Facebook in 2012, we're talking about a platform that, frankly, figured out mobile advertising before anyone else and just rode that wave for a decade. Is Reddit really at that same inflection point? Or is this just, a lucky quarter?
I think the data suggests it's structural, not lucky. I mean, look at the headline number.
Okay.
$726 million in revenue for just the fourth quarter.
Wow.
That's a 70% increase year over year. And if you zoom out to the full year, 2025, they hit $2.2 billion, a 69% jump.
Right.
You don't get almost 70% growth by accident. This is real acceleration.
Acceleration is the key word. But let's dig into the how, because you and I have both used Reddit for years. Historically, the ads were, let's be honest, they were terrible.
Oh, they were awful, irrelevant, intrusive.
Exactly. So how do they go from that to a 70% revenue jump? What changed in the plumbing?
They finally cracked the code on context. It's something they're calling conversation placement. In the past, advertisers were treating Reddit like a billboard.
Just shouting at people.
Just shouting at people as they walked by. Now, they are inserting ads directly into the comment threads, right where the actual engagement happens.
So instead of a generic banner on the side, if I'm reading a thread about, say, grinding coffee beans for espresso.
Exactly. You're not just seeing an ad for coffee. You're seeing an ad for a specific high-end burr grinder placed right between two comments debating burr sizes.
So the relevance is off the charts.
It is. They're using machine learning to understand the sentiment of the conversation, not just the keywords.
That's a crucial distinction. Keyword targeting is, I see the word coffee, I show a coffee ad.
Right.
Sentiment analysis is, these people are passionate about precision, so I'm going to show them a precision tool. That drives up the value of that ad slot significantly.
And that's why the revenue is exploding. Advertisers are willing to pay way higher CPMs cost per 1,000 impressions because the user intent is so much higher.
It's strikingly similar to what we saw with Facebook around 2012.
It really is. You have this massive, highly engaged audience, and then suddenly the ad machine just clicks into gear. The inventory was always there, but now the inventory is actually valuable.
It's interesting you mentioned the inventory being there because you can't squeeze more money out of a shrinking user base forever. You need fresh blood.
Right.
How are the user metrics holding up against this aggressive monetization?
Yeah.
Usually when you flood a platform with ads, users revolt.
That was the fear, wasn't it, that the core Redditors would leave. But the opposite happened. The daily active uniques, what they call DAU crews, 19%.
19%.
To 121.4 million. That is a very, very healthy number. It shows they're still attracting new eyeballs.
121 million is a serious number. But I want to highlight the moat here.
Yeah, let's talk about that.
In investing, the moat is that defensive wall that keeps competitors from stealing your lunch. People compare Reddit to X or TikTok, but I think the use case is fundamentally different.
It is. It's built on network effects, but specifically around utility. It's about authentic niche discussions. I mean, think about it. When you Google something specific now, do you just search the term?
No, I search the term plus Reddit constantly.
Right.
If I'm looking for a review of a vacuum cleaner, I don't want the SEO spam blog post. I want the thread where Vacuum Repair Guy 88 tells me which model has a faulty motor.
Exactly. That is the moat. That content is user-generated and community-moderated. It's incredibly hard to replicate that trust in depth.
It really is.
You can't just clone 15 years of specific, technical, human conversation and archive knowledge overnight.
That's the difference, isn't it? It's a library of human experience, not a feed of entertainment. And that connects right back to your Facebook 2012 comparison.
How so?
Back then, Facebook had the social graph, who knows who. Reddit has the interest graph, who cares about what. And monetizing an interest graph is actually easier in some ways.
Because the purchase intent is built in.
It's built right in. If you're advertising in a subreddit dedicated to mechanical keyboards, you don't have to guess if the user is interested. They are literally there to talk about them.
That efficiency is what's driving that 70% revenue surge.
Okay, now let's pivot to the financials. Because revenue is great, top-line growth is exciting, but financial flexibility is what keeps a company safe. And they announced something pretty shocking about their cash pile post-Q4.
They did. They announced a $1 billion share repurchase program.
I have to play devil's advocate here. $1 billion. For a company that's supposed to be in hyper-growth mode.
It seems counterintuitive.
Yeah. Usually you see growth companies pouring every single dollar back into R&D, sales, marketing. Buybacks are what, Coca-Cola or Apple do. Does this imply they've run out of ideas on how to grow?
That's the skeptical view, and it's valid. But I see it differently. I think it's a flex.
A flex.
It signals two things. One, they have a rock-solid balance sheet, minimal debt. But two, and this is key, their business model has become incredibly capital light.
So you're saying they are generating so much free cash flow from this new ad engine that they can afford to do both, reinvest and return capital.
Exactly. They can reinvest in the business, in AI, in ad tech, and still have enough left over to reward shareholders by reducing the share count. It's a massive confidence signal.
It tells the market we are profitable, we are safe, and we believe our stock is undervalued.
And that confidence seems to be contagious. I mean, the analyst reports rolling in since earnings, the whole mood has shifted from wait and see to don't miss out.
It's definitely bullish. You have Argus raising their price target from 250 all the way up to 300.
That is a significant hike.
And then Evercore ISI starts their coverage expecting outperformance. They see the psychological resistance clearing on the chart.
And it's not just the analysts writing reports, it's the big money actually moving.
Institutional money.
Right. We tracked the 13F filings, and Bailey Gifford was accumulating shares in Q4.
And for those who don't follow the fund world, Bailey Gifford is legendary for backing big growth winners early. They're in Tesla, they're in Amazon.
Very early.
When you see smart money like that positioning themselves, it reinforces the idea that this isn't just a retail hype cycle. They're building a position for the next 5 years.
Okay, but we need to take off the rose-colored glasses.
Right.
We've laid out a very strong bull case. Massive growth, sticky users, cash generation. But what could derail this train?
Well, the biggest risk right now is simply the game of expectations. They have set the bar incredibly high. When you post 70% growth, the market starts to expect perfection.
So it's the curse of the beaten raised.
Precisely. If they drop to, say, 50% growth next quarter, which, by the way, would still be phenomenal for any other company, the stock could get hammered.
It's priced for perfection.
Absolutely. If execution slips or if margins don't expand as fast as predicted, the multiple compression can be brutal.
That execution risk is real. But what about outside threats? We hear a lot about social media regulation, especially around younger users.
That is a significant headwind, and it's not going away. There's a growing global movement for youth, social media restrictions, general addiction awareness.
We're seeing proposed laws in Europe, in the US.
And that threatens the pipeline of new users, doesn't it? The funnel at the top gets restricted.
It threatens the future super users. Think about your own usage. You probably started using these platforms when you were younger.
If that funnel gets smaller, that 19% user growth figure becomes much harder to maintain 3 or 4 years from now.
And even with their moat, they are still fighting for ad dollars.
Oh, absolutely. It's a zero-sum game in many ways. An advertiser has a budget. If they spend $1 on Reddit, that's $1 they aren't spending on Meta, Snap, or TikTok.
And Meta is a monster.
It's a monster. If Meta introduces a new AI targeting tool that performs just slightly better, money flows there instantly. Reddit has to constantly prove its ROI is competitive with the giants.
Which is why it's interesting that despite all this hype we've talked about, some of the sentiment scores are still flashing neutral.
That's a crucial nuance. Not everyone is convinced. There is skepticism about whether they can scale their ad tech fast enough.
So people are on the sidelines?
They're on the sidelines, waiting for the other shoe to drop, maybe worried about a ceiling on user count. They're asking, is there a limit to how many people actually want to read text-based threads in a video-first world?
That is a fair question. So if I'm watching this stock, what are the triggers for 2026? What should be on my radar for the next 90 days?
The immediate thing is Q1 2026 earnings. We expect those late April, maybe early May. But don't just look at the top line.
What's the magic number we should be hunting for?
We need to see if they can sustain 40% plus growth. After a 70% beat, the year-over-year comps get really tough.
So anything less than 40 might be seen as a slowdown.
It might be viewed as a peak, not a trend. But there is a wild card we haven't touched on enough yet.
You mean the AI angle?
AI and data licensing. This is this sleeper hit of the thesis. Everyone is focused on ads, but the data licensing revenue could be pure profit.
Talk to me about that. We know they did deals with Google and OpenAI in the past. Why is this a trigger now for 2026?
Because the AI models are hitting a wall with synthetic data. They need human reasoning. They need nuance, sarcasm, debate, problem solving.
And where does that exist on the internet?
It's not on Instagram, that's images. It's not on TikTok, that's video. It's on Reddit.
So Reddit is effectively holding the textbook that teaches AI how to think like a human.
That's the perfect analogy. And that textbook is getting more valuable by the day. There's a lot of speculation about perplexity-style monetization or deeper integrations where Reddit gets a cut of the query.
So a big new partnership announcement?
If they announce a major new licensing revenue stream in the next 90 days, that changes the valuation model entirely. It moves them from an ad company to a data infrastructure company.
That would be a massive catalyst that I don't think is fully priced in yet.
I agree. And finally, you just can't ignore the macro environment.
Sector rotations.
Right. As interest rates potentially come down, we often see a rotation back into high-growth tech. Lower rates also tend to boost advertiser budgets.
A rising tide lifts all boats.
It does, but it lifts advertising platforms like Reddit, specifically because they're considered risk-on assets.
So putting it all together, it feels like we have a company that has fundamentally turned a corner.
I think so.
To summarize the thesis for everyone listening, you have a company delivering 70% revenue growth, backing it up with a billion-dollar buyback, and sitting on a sticky user base of over 121 million daily active users.
And they've cracked the code on contextual ads while sitting on a data goldmine for the AI revolution.
It sounds like they're positioning themselves as an early monetization powerhouse.
But the risks of execution and regulation are very real.
And that is the lowdown. The main question for you, the listener, is whether you believe the 2012 Facebook parallel will hold true through 2026. If it does, and if they can navigate the regulatory waters, we might just be in the early innings of a much bigger story.
But if they stumble on execution, it could be a bumpy ride.
It could. Well, that gives us plenty to think about. Thanks for breaking it all down.
Anytime.
Absolutely. And remember, if you want to stay ahead of these market moves, make sure to subscribe and hit that like button. We'll catch you on the next one.
See you next time.